In the quiet but calculated corridors of European finance, one of the most underestimated yet potentially groundbreaking shifts is unfolding. Denmark, often seen as a peripheral economy compared to the heavyweights of the Eurozone, is quietly positioning itself at the crossroads of global payments, innovation, and currency stability. The combination of its integration into Target, the European Central Bank's advanced real-time payment system, and its unique policy of pegging the Danish krone to the euro is creating an unusual but highly consequential financial story. At first glance, it may seem technical, even boring, a matter of plumbing in the vast system of European finance. But to hedge funds, institutional investors, and offshore banking strategists, this development is nothing short of a tectonic shift. The story here is not only about payment systems, it's about monetary sovereignty, currency credibility, and the architecture of the global financial order in 2025 and beyond. For decades, Denmark has lived with a paradox. It is a member of the European Union, but not of the Eurozone. It has one of the most stable currencies in the world, yet that currency, the Danish krone, is deliberately shackled to the euro. It operates a sophisticated domestic banking system, yet it has remained somewhat isolated from the grand experiments of European monetary integration. That paradox is now dissolving with the country's decision to fully integrate into Target, the euro system's next-generation settlement infrastructure. To understand the magnitude of this, we need to understand what Target represents. It is not just another payment system, it is Europe's ultimate weapon in achieving financial unity. Target provides real-time gross settlement, instant cross-border transfers, and direct liquidity management across central banks in ways that make traditional systems like SWIFT look sluggish, outdated, and fragmented. By plugging into Target, Denmark is effectively embedding itself into the heartbeat of Europe's financial nervous system, despite not being a euro country. This creates an extraordinary situation. The Danish krone, pegged tightly to the euro, becomes even more synchronized with European monetary operations. Historically, Denmark's national bank, has used interest rate adjustments, interventions in FX markets, and a carefully managed peg policy to keep the krone stable against the euro. That peg has survived crises, speculative attacks, and shifting economic winds. But now, in 2025, with Target integration, the peg takes on an entirely new dimension. Payments, capital flows, and liquidity management between Denmark and the Eurozone will operate with virtually no friction. This could enhance the credibility of the peg, but also expose Denmark to systemic risks and opportunities in ways the market hasn't fully priced in yet. For global hedge funds, this is where the narrative sharpens. Hedge funds thrive on asymmetries, and in Denmark's case, there are two competing asymmetries at play. The first is the stability premium. Investors looking for safety in an uncertain Europe, a Europe facing inflation volatility, trade disruptions, and political fragmentation, will increasingly see the krone as a quasi-euro safe asset. It's like owning a euro without being exposed to all the euro's political baggage. This stability premium makes Danish assets, government bonds, real estate, and even equities more attractive to offshore investors. But the second asymmetry is the speculative risk of the peg itself. The krone peg has always been vulnerable to stress during global financial crises. By linking itself more deeply into Target, Denmark may be increasing its exposure to euro liquidity shocks, banking crises, or policy missteps from the European Central Bank. For a hedge fund strategist, this is not just a technical footnote, it is a potential billion-dollar opportunity. Consider how George Soros famously broke the Bank of England in 1992 by betting against the pound in the exchange rate mechanism. Denmark's peg today is more robust than the UK's was then, but history whispers reminders. If, for example, the ECB were to cut rates aggressively to fight recession while Denmark faced inflationary pressures at home, the national bank would be forced to follow suit to maintain the peg, even if it wasn't in its domestic interest. This tension creates scenarios where hedge funds could test the peg, either through short-term speculation in FX markets or through longer-term positioning in Danish assets. The Target integration, paradoxically, makes these flows easier, faster, and more consequential. But beyond hedge funds, let's step back and look at the broader European payments landscape. In 2025, Europe is racing to modernize its payment architecture to keep pace with the United States and China. FedNow in the US is slowly gaining traction, enabling real-time payments across American banks. Meanwhile, China's CIPS system, linked to its Belt and Road ambitions, is challenging the dominance of SWIFT in Asia and Africa. Europe's answer is Target and TIPS, Target Instant Payment Settlement. With Target, the European Central Bank is not just building a payment system, it is building sovereignty and financial plumbing, independence from SWIFT vulnerabilities, and resilience against geopolitical risks like U.S. sanctions pressure. By joining this system, Denmark is not only future-proofing its banking sector, but also cementing its role as a gateway for global capital into Europe. Imagine this scenario. A Canadian pension fund wants to invest in European green bonds, but prefers a stable currency and predictable monetary policy environment. Instead of directly investing in euro-denominated assets, they could flow capital into Danish markets, confident that the krone will shadow the euro through the peg. And because target integration makes settlement seamless, the cost of doing so plummets. For offshore bankers and wealth managers in Switzerland, Singapore, or even the Caribbean, Denmark suddenly becomes a more attractive jurisdiction for routing European investments. The krone peg, once seen as a quirk, becomes a strategic anchor. And yet, there are risks. The very act of integration means Denmark is tethering itself more tightly to the euro's fate. If Europe enters a sovereign debt crisis, if populist politics undermine ECB credibility, or if inflation dynamics diverge too sharply, Denmark may find itself forced into policy choices that erode domestic flexibility. Offshore investors are already calculating scenarios. What happens if the peg is abandoned? What happens if Denmark is forced into the euro? What happens if Target creates systemic vulnerabilities during cyber attacks or liquidity crunches? These are not abstract questions. They are real variables that traders, hedge funds, and global banks are building into their 2025 models. Let's talk numbers. As of early 2025, Denmark's economy is projected to grow around 1.3%, slower than the broader EU average. But its inflation rate at 2.2% is slightly below the Eurozone's 2.5%. Its foreign exchange reserves stand at nearly 100 billion euros, a massive war chest designed to defend the peg. Its government debt-to-GDP ratio is among the lowest in Europe, under 35%, making it a magnet for safe haven seekers. These fundamentals give the peg strength, but they also raise questions. With target integration, capital inflows could surge, putting upward pressure on the krone. That means the national bank may have to intervene even more actively in FX markets, further entangling itself with ECB dynamics. Every intervention, every adjustment, will now ripple through target faster than ever before, amplifying both stability and fragility. For ordinary Europeans, these changes may go unnoticed. Payments will become faster, cross-border transactions will feel seamless, and businesses will enjoy lower costs. But for those watching at the top of the financial food chain, hedge funds, sovereign wealth funds, offshore bankers, this is a chess game with trillion-dollar implications. Denmark, a small country of less than 6 million people, is suddenly sitting on a lever that could shift the entire European payments balance. Its decisions will reverberate not just through Copenhagen, but through London, Frankfurt, Zurich, and even Wall Street. The story of Denmark's target integration and krone peg is not about whether payments become faster. It is about the very nature of financial sovereignty in an interconnected world. Will Denmark remain the quiet safe haven, the Switzerland of the North, quietly absorbing capital as Europe stumbles forward? Or will it become the next battleground in the global war of currencies and payment systems? Hedge funds are watching, offshore bankers are positioning, billionaires are already whispering strategies in closed-door meetings. And the rest of us? We are watching history being written in the fine print of payment systems and currency pegs. This is how Denmark, through two seemingly technical decisions, could rewrite the future of European payments.